See, as you know, that we have also evolved into a small finance bank by being an NBFC first, and the NBFCs or small finance bank like ourselves cater to specific niches of customers or small value loans or financial inclusion loans, and reach out to geographies which are typically not addressed by the universal public sector banks or the private sector banks. So in that sense, we genuinely see that be it the small finance banks or the NBFCs are working in a very collaborative manner and offering products and services which are generally not offered, and helping deepen the financial inclusion agenda and helping unbanked or underbanked customers get more products. So we believe that this is a coexistence model. Everything cannot be done by one person. And banks have advantage of offering multiple products, offering deposit solutions to the customers versus NBFCs. But NBFCs are very focused and they do a very specialized jobs in the products that they do. So this is a mutual journey, both trying to deepen the financial inclusion agenda of the country. This branch question is very interesting. Typically, the larger frame which the world is now working towards is that banks should ideally need less branches to service their customers, and contrary to that, even right now we are seeing in India the number of branches increasing by the private sector banks or banks like ourselves, and I think the fundamental reason for that goes down that we are still a country where the bank penetration and the branch penetration is still very poor. What we have experienced is that branches are not necessary for customers to visit and do business with, but they are very necessary in a customer's thinking and psychology for their existence in a reasonable close proximity, so that they can build trust with that institution where they're going to deposit the money or take loans from or take payment solutions from. So given the fact that we are so under-penetrated, I think the branch network will further grow over the years, but it may not grow at the same pace as it was growing 5 years back, but because clearly digital solutions are there and people are visiting less branches. But I still see a growth out there. Banks like ourselves, which are growing deeper in the country, putting up, doing business in more cities, it is absolutely necessary for our employees, for our customers to see 1 or 2 branches in every city where we operate in, and therefore you will see a growth of branch network from banks like ourselves. Generally, an institution can do 2-3 kinds of loans. One, you can do an individual loan of an unsecured category. You can do an individual loan of a secured category, and then there are what we are doing these loans, but doing through a value chain system. And explain the difference. So when we do unsecured loan, in an individual category, we are doing microfinance loans, but we are doing it in a group format. So it's easier to identify customers, underwrite the credit of those customers, and also service those customers going forward, because the nature of the loan is very small. In a secured loan, you move away from the group concept, but you introduce a collateral for the credit and for the comfort of the security of the loan. So the key element is, how do you develop a reasonable mechanism to underwrite customers and to service them on a regular basis. So for the kind of typical example that you gave, I think where we can call them value chain banking. If these people, if the weavers get integrated in a value chain where they are now part of an ecosystem where the people who are buying products for them and therefore paying them for their services, and that chain gets completed, like typically we see it in a milk dairy concept where the farmers are integrated are connected to a dairy, and the dairy makes payments to the bank accounts. So once a value chain gets created of a supplier, of a buyer, and the payment mechanism between them, then it becomes easy for a financial institution like ourselves to step in and do what I call a multi-party arrangement, where you can derive comfort from the transactions which are happening in the value chain, because there is official records which can be kept, and then you can derive comfort from the fact that the payments which are being made from the consumer of their products or the buyer of their products are in some sense as a guarantee for servicing the loans. So typically I would say that what we look for is that either we continue to do loans in an individual capacity, where we can underwrite them either in unsecured manner or a secured manner and work with them. And we do a lot of SME loans across the country at this point of time. But however, the superior model always is to create a value chain linkage so that we can underwrite them far more easier, we can service them far more easier, make it much more affordable for them, and give them higher loans than what they typically get in Indian loan capacity. So I would say going the value chain way, going a group way would help address some of those needs.